You get filled for 820, and then you go down to the next bid. And maybe the bid is 10, maybe the bid's 5, maybe the bid's 4. Now we're starting to maybe see what's happening. The less liquid a market is, the less bids will be in the market. Got that? And when you sell something at market, where's it going to go? It's going to go to the next bid. It's not going to go to the last. The last is ancient freaking history. Now, what's an initiating stop? For those of you that have systems that act on entering an order if it goes through a particular range, either on the buy side or the sell side, an initiating stop order would be one in which you hit that level and you are then filled somewhere. You don't know where because it turns into a market order. You are then filled and you are now in this thing. Protective stop gets you out. Initiating a market puts you in. So, most people that trade, or many at least, do not internalize the idea that they must have a bid in order to get out of their position. Now let's go through one more thing that has to do with sub-penny pricing. I was doing a seminar in Bangkok, and in lifetime advanced seminars we trade. I had 4,000 or 5,000 shares of some stock, I forget what it was. Probably an ETF. I love trading triple ETFs. If you guys haven't traded triple ETFs yet, boy, they are the nuts. You can make a whole lot of money. Lose a whole lot too. Now, I had bought the stock somewhere, and I had one of my Dinapoli levels at about 2408 or 2407. So I front run the level a little bit, and I put my sell order in at 2402. That's where I was selling, at 2402. I got busy with the students. I was quite confident that that would be met. The market was up. The market was strong. There was nothing between wherever the market was in my 2402 order. So got busy with the students. 15 minutes later, I came back, and I saw that the high was 24.199. What the hell is that? Somebody had put in an offer, what is that, 1/100th of a penny before me. 1/100th of a penny. This is what your high-frequency traders are doing. They're sticking orders in 100th of a cent before yours. Now, what they're saying out there when they're interviewed is, we're providing market liquidity. We're helping the markets. We are just trading for little tiny increments. Well, you know what I say? I say BS. BS, because what they've just done is robbed me of my fill. They might have made 5/100ths of a cent, but they cost me 20 or 30 cents because this thing was on its way down after it hit that level. The level that I had calculated, the risk that I had taken. They picked my pocket. Now, as a professional trader, well, what do you think my reaction is aside from spitting at the screen? No, I don't do that. Often. My reaction is to trade less, not to take the risk, because these guys are out there stealing from me. And what does that do to market liquidity? Drops it, doesn't it? This guy, Dennis Dick, a good name for a trader. He trades for Bright Trading. And this is the truth. Mr. Dick Mr. Dick was was trading during the flash crash. And Mr. Dick put an order in for a preferred Microsoft bunch. I don't know what the size was. Wanted to get long on preferred Microsoft. What am I saying? It's Morgan Stanley, MS. All right. He wanted to buy some of this stuff. Now, he looked at the bid and the ask. All right, remember, bid and the ask. Last is gone. Last is 100 years ago. Doesn't mean a thing. All right? The ask is 20. The bid is 0. The bid's 0. So if you sold something at the market, what would you get? Where would you be filled? 0? That's a good place to buy. All right. The point is, there were no bids. So what did he do? Dennis bids. You notice I spelled Dick right, but not Dennis. Okay, so Dennis bids 13 even. This is a true story, by the way. I'm not making this up. Dennis bids 13 for Morgan Stanley, and the next thing he knows, a flash trader comes in and bids 13, oh, that's wrong, 13.001. It should be in the hundreds. Way over there in the hundreds. So what's happening is that a guy's bidding 100th of a cent above him during the flash crash. All right, so Dennis goes, all right, I'm going to bid 14. What happens? Flash traders come in and bid 14.0001. Effectively, what these guys are doing is robbing Dennis of his fill. Dennis, during the flash crash, couldn't get a fill. Now, what do you suppose this does to Dennis? Dennis has the same reaction Dinapoli has. He says, what is the point? Now, let me tell you how these guys work it. If they buy at 1301, right, Dennis's bid is still in there at 13. Now, if the market goes up, they can make a whole pot of money. If the market goes down, they can hand whatever they bought to Dennis. You know, okay, heads you win, tail I lose. Why the hell am I going to trade? Right? And what does this do to liquidity? It drops it. I mean, did you understand that last part? Now, these guys can trade so fast, they have such an advantage that if Dennis cancels his order, they can hit him before he can get out. You know, where are the regulators? You know, we're killing market liquidity every day. Mini crash flashes. PGN lost 90% of its value. This is a company in minutes. Now, here's what's going on. Remember I told you the markets were never fair. Let me tell you what's going on in the E-mini and other markets every day. They are people with some size can crash the market down to levels that any professional trader knows their stops, break the market down there, gather the sell stops, buy some inventory, and ram it back up again. This happens this was happened in 1980, 1985. That's just normal. Today, because of the illiquidity, large concerns can take and crush a market, trigger all the stop loss orders, gather all this inventory, and ram it back up again. And they ruin the equity market. The risk of killing the goose that laid the golden egg so that they can make themselves their $10 million for that day. And what do the regulators do? Okay. There have been, I just got a paper there that outlines something like 300 mini flash crashes in the last few months. Different stocks have been crushed in the last 3 months. And this is all so these guys can make their money, and it puts the rest of us at risk. It puts the markets at risk. Now let me show you something that can happen here. Talk about the bid and the ask. If you've got a falling market, a market that is coming down like this, we have bids below the market. Once the selling, once you hit a stop loss and the selling occurs, you can eat up these bids, and the next thing you know, you can fall very rapidly from a price of 88 or 89 down to 1. It can come right apart. All these guys need to do is break the shell of bids, push it, cram it, step on it, crush it, and then it's a free fall where they can collect whatever they can collect and then drink back up again. Public's not so stupid. Public's not so stupid. They're saying, hey, this game's rigged. The game's always been rigged, but the game is worse now. All right, now let me show you a few things about Dinapoli levels. Because understanding how I trade will allow you to understand what I see as a potential for this market. And you can decide for yourself whether or not Armageddon is on its way. Out of the myriad of Fibonacci ratios, I use 2 retracement ratios and 3 expansion ratios. By the way, I do not expect you to understand Dinapoli levels because I'm going to try and teach it to you in 5 minutes. It's impossible, all right? I have a book if you want to read it, study it. And I'm going to go through it fairly quickly so you have some idea of why I think the way I'm thinking. 2 retracement ratios, 3 expansion ratios. The retracement ratios are primarily for entering the market. Expansion ratios are for taking profits. Basic Fibonacci analysis says that if there's a down move, that the vertical distance between A and B, you will have resistance at a 0.382 ratio. You'll also have resistance or selling at a 0.618 ratio. On an upmarket move, you will have support at approximately 40% down. You will have support at approximately 60% down. That is very basic Fibonacci analysis. One thing you could do here is buy above the 0.382, put a sell stop below the 0.618. This is expansion analysis. If you have a market move that goes from A to B, retracement to C, it is likely to go to 3 possible profit objectives: contracted objective point, or expanded objective point. These objective points are ruled by the Fibonacci ratios of 0.618, 1, and 1.618. The COP is 0.618 times the vertical distance between A and B. The OP is 1 times the vertical distance between A and B. The XOP is 1.618 times the vertical distance between A and B. I'm going to say something fairly bold here. I really believe it to be true. There is no single thing you can learn, that would be more beneficial to your trading career than this. Because once you learn how to place these ABCs, you can, with unbelievable accuracy, determine where markets are likely to go. Let's go on. Here's an example of a BHP Billiton, and I take this example only because it's a highly liquid stock. Remember I told you that all trading systems, including my own, work the best with levels of high liquidity. You do a simple A, B, C here. The COP had a reaction, the OP had a nice reaction, the XOP had a big reaction. Now let's talk about drop in the time frame, and let's talk about how this affects Dinapoli levels. If you have a weekly chart, it would be represented by 1 bar, and let's assume that a daily chart would have 7 bars. This thing trades every day, so 1, 2, 3, 4, 5, 6, 7. Notice that you have on the weekly, on the 1 bar, you have 1 high and 1 low. On the daily bar, you have 1 high and 2 lows. If you were to go to an hourly bar or a 5-minute bar, you could get more reaction lows. Now keep that in your mind when we go to the next slide.